For the past 14 years, dividend growth investing has been at the core of my strategy. Today, we're looking at 10 amazing dividend growers.
Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my magnificent co-host, part of the Magnificent Seven, actually. Véro, how are you doing?
I'm good, but who are the other six?
I'm just making a pretty bad link with the Magnificent Seven of the S&P 500, but no, I don't have any other six. You're the only one.
All right. So I'm doing good, yeah. And thank you for
You're all off guard right now. You're just like, what the hell he's talking about?
Yeah, I'm like, okay, Magnificent Seven, okay, but yeah, I got the link between the S&P 500 and mine, but I mean, it's a nice compliment. I'll take it. So last week we shared 4 tricks to avoid dividend cuts, 2 of which were to avoid a weak dividend triangle and an absence of dividend growth. So today we put that into action by sharing 10 stocks that show double digits dividend triangles, meaning they represent amazing dividend growers.
Yeah, so we're starting with the idea that it's pretty tough to find a bad companies showing double-digit revenue growth, earnings, and dividend for the past 5 years. They're not all perfect. They're not necessarily like all right, obvious buys today, but they should be on your buy list. When you think about that, a business that is growing double-digit will tend to do well in the stock market. And dividend growers, like in general, if you look at the past 50 years, a lot of studies shows that they tend to outperform the market and do it with less volatility. So the stock price will not be that much hurt during a recession or a market crash.
Mm-hmm.
The reason is quite simple. Those are thriving businesses. And thriving businesses, well, investors wants to invest in those. And keep in mind, the dividend doesn't make those companies magical. The dividend growth is a consequence of a thriving business. And this is what we are after today.
So, quick reminder before we start, please do not consider today's stock ideas as buy or sell recommendations. Do your own due diligence before buying or selling an equity. So, first, Mike, for the benefit of listeners who might not know it yet, summarize what the dividend triangle is.
Yeah, so in a nutshell, it's 3 financial metrics that I use as the foundation of my investment analysis. So I look at trends for revenue, earnings per share, and dividend growth. In other words, I want a company that grows their sales, find ways to make more money, and share the wealth with shareholders.
Mhm.
Those are leading metrics that will likely lead to a business with healthy margin, a strong balance sheet, low payout ratio, a lot of cash flow, and so on. So once you have that combination of those magical 3 numbers all together pointing towards the right direction, when you continue to dig further in the financial statements, you're always going to find good news.
Okay, so let's start with a sector that you normally don't like much, energy. The Canadian market is a good place to find some stocks in this sector, but Canadian Natural Resources, C&Q, is a perfect example of a double-digit dividend triangle, right?
Yeah, you just have to be a bit careful with the energy sector when you look at the past 5 years right now, because we're kind of like getting close to the bottom of like 2020. So it's like this year and next year, you're going to capture a lot of growth, but you're going to also see that you're starting the point of analysis at the lowest point possible.
Mm.
But for Canadian Natural Resources, they've been around for a very long time. They've been increasing their dividend for almost 30 consecutive years. And the past 5 years have been just amazing. So past 5 years of revenue growth is at 13%. The earnings per share is at 29%, and the dividend growth is at 22.5. Don't expect those numbers to keep on going forever, of course. I mean, we're talking about a very solid dividend triangle, but it is temporary because of what just happened between 2020 and 2021.
So last week we mentioned how the numbers and the story have to match and back each other. So what's your investment thesis for CNQ?
So, as you know, I'm not a big fan in general of the energy sector, mostly because almost all those companies highly depend on commodity prices and they have no control of that. So, whenever the oil price is down, they have to get into debt, they have to slash their dividend, and they make poor investments. But when it goes up, you look like a genius. CNQ is completely different because they are vertically integrated. So they have the exploration, the transportation, and storage, and they're selling inside their business model. So they are able to make money at each level. And one key quality that CNQ has is its high quality asset. It can be profitable even if the oil barrel trades around 35 bucks. So in a world we are today that the oil barrel trades above $70, this means a lot of cash flow is flowing in the business. So CNQ is buying back shares, paying down their debt, and increasing their dividend all together at the same time. And this is what I really like about this one. As you said, it's a perfect example of a business that shows strong numbers and a seductive narrative, and everything comes together. However, moving forward, do not expect this business to grow always double digit. I think it was more like a temporary thing, but it still makes it a very solid investment if you're looking for a stock that shows a relatively high yield for the growth it brings.
Mhm. Another stock that deserves to be noted, even if it's part of a sector that you tend to avoid, is United Health Group, UNH. And besides, it was a replacement for CVS Health from last week's episode. So, what does its dividend triangle look like, Mike?
So you see that we kind of like have those like trends here where you're kind of making sense from one episode to the other. So if you have not listened to this one, you have to go back for sure and listen to it. So UNH revenue trend keeps on growing almost steadily every single year. So the past 5 years, it's up 10%, almost 10.5% annualized growth rate. The earnings at 14. Mind you, it's going to drop big time because they had a pretty bad year so far in 2024. They had to reported a lot of expenses related to the cyber attack that they got into that completely blocked the business for several weeks. Now there are lawsuits as well. So of course it's going to be a tougher period for UNH, and it's potentially a pretty interesting opportunity at this point because while the dividend triangle has been very solid, the stock price is about the same as it was trading around 2022. So we're going like from short drops around 400 bucks, most of the time trading around 500, and sometimes was close to 600. So for the past 2 years, not much growth for the stock price, while revenue, earnings, and dividend has grown accordingly.
And what would be the reasons to add it to your portfolio?
So it's the largest private health insurance provider in the US. And what I really like about this one, it's they build their business model as a one-stop shop. So they offer the medical insurance, they offer the pharmacy benefits manager. So they manage all of those insurance for the employers, and they provide some healthcare services as well. They showed this great ability to adapt their business model and find growth vectors in an ever-changing and highly regulated industry, which is definitely a key here to demonstrate this kind of expertise in a more difficult sector to navigate.
Now, in the financial sector, we have Go Easy, GSY.TO, and MasterCard, MA. What do you like about their dividend triangles? And I'm just tempted to add it's not National Bank and it's not Visa. So it's kind of a surprise here.
What's going on, right? I mean, well, to be fair, I just decided to pick MasterCard this time, but MasterCard and Visa is kind of like the same business, but split in two. So not much different. Actually, I have in my plan to do a YouTube video to compare MasterCard and Visa and go deep do a deep dive to actually try to find like very big differences. I'm not too sure I'm going to be able to do that because they do have the same business model. And what is amazing about MasterCard and also Visa is it's just always going up. I mean, when you look at the dividend triangle for this one over the past 10 years, there's only one slightly down moment, and it was during the pandemic. So
Mhm.
between 2020 and 2021, before and after, it's almost like two straight lines that is actually going hand in hand with the dividend growth. So you
Right.
have like revenue growth at 11%. You have earnings per share at 16%, so telling you that they're having better margin right now that they had before because the earnings are growing faster than the revenue, and the dividend is growing almost at the same pace at 18%. So while for the long haul, it's hard to imagine that MasterCard and Visa will be able to increase their dividend double digit forever, but as long as the earnings are in the double digit growth, it is a possibility. Going back for Go Easy for a second here. This one is a little bit more rock and roll. So it goes up, goes down in terms of stock price. They
Mhm.
had a pretty solid year in 2021 and 2022 of earnings, but overall, everything is growing very, very fast. So we're talking about 20% for the revenue growth rate, 32% for the earnings, and 33 for the dividend. Again, don't expect those kind of crazy numbers forever, but right
Mhm.
now they've been on a tear for a long time. And what is great is for Go Easy, they reach a peak in value towards the end of 2021. So right before we started to see more interest rate increases. In 22, it was downhill because the market was concerned about provision for credit losses. And now the stock price is recovering, but it's not at its peak value yet.
And why would an investor buy Go Easy or MasterCard?
So for Go Easy, this one is of course highly volatile. I think that there's still room to grow as long as they continue to show low provision for credit losses. So one key point here is when I analyze this type of business, I'm like, yeah, this is the type of business that looks good on prom night. So when the
Mm.
economy is rolling, they're making a lot of money because of course they're offering loan services to people that don't typically won't go to their banks. It doesn't mean that they have bad credits, but they have like a more complicated file, for example. Like think about a self-employed that
Mhm.
has not like huge income that are declared, but still rolls a new car and has a house. So this is the type of underwriting they will do, charging a little bit more interest rate on their loans. So this is how they maintain a higher margin than a classic bank, but of course, they also have a lot more charge-offs. So a lot more customers that don't pay their loans completely. But overall, they've been able to maintain that target charge-off below 10%. And this business model rose. It's highly profitable. So as long as their underwriting process to give those loans to the right clients work, I don't see any problem. But
Mm.
this is definitely the type of business I would follow quarterly. Now for MasterCard, I mean, nearly perfect business model. I would say that the only disadvantage of MasterCard is it's always seems to be highly valued and you always seems to be buying it at the all-time high.
Mhm.
When I pulled the trigger on Visa in 2017, I was like just lurking on those two stocks for since their IPO. I think it was in 2009 or 2010. And every year was the same problem. Oh, I'm not going to pull the trigger now because it seems like it's trading at an all-time high. Well, the thing is you have to pay for quality, and they show recurring business model, a strong moat. As people are traveling more these days, it's like the cross-border fees are amazing for them, so they're making more money. There's only two players in this industry, and the thing that a lot of people keeps on forgetting when they think about, oh my god, there's a recession coming, is MasterCard and Visa, they do not carry the debt on their
Right.
balance sheet. That's the bank's problem, not
Mm.
their problem. They're really just the payment processor. So they're making money on the transaction, not on the interest paid on the card.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. So, in the industrial sector, you selected two companies to represent a double digit dividend triangle: TFI International and Deere. Do they show a perfect dividend triangle?
No, and that's what makes them interesting. So both of them, I mean, now you have to understand the nature of like sectors. So for the industrial sector, of course, it is a cyclical sector, meaning that when the economy goes well, that means that consumers are spending. And of course, that also means that you need more transportation of goods. So TFI International is following the economy, surfing on that, but they saw a slowdown starting in 23. So earnings and revenue declined about the same level, mostly because of this. However, before that, this is a company that is at a great place because they grow by acquisition, more than 80 acquisitions since 2015. They have a perfect playbook. We just discussed this company not too long ago on the show, so you can go back on the previous episodes on there. But just to show you how fast this company is growing, revenue growth over the past 5 years at 16%, the earnings per share at 21, and the dividend is at 18%. So a lot of growth there. And when there's a recession, they're going to make more acquisitions. So just opening the door for more growth going down the line. For Deere, we do have an interesting situation where we had like a very solid growth for a while. Now we're reaching a plateau as well. And the stock price is hovering about the same price since the mid 2021. So it's been like 3 full years right now that there's not necessarily a gain or a loss on the stock price, but the revenue and the earnings have reached like pretty high level. Of course, we're reaching a plateau again because it's cyclical. So you just have to do a little bit more research on this one to see, are they able to go back on another wave as they did before? Because that's an advantage at Dividend Stocks Rock is we provide those dividend triangle for 10 years. And the best the most important advantage to look at the past 10 years instead of 5 is to look at the trend like before. So you see a full economic cycle. So you see that in the past, it has been like just you see those cycles between 2015 and 2017, revenue and earnings decreased, and then it went back up all the way up to in 2020, and then 2020, 2021, not that great. Then another jump. Now we're reaching another plateau. Chances are the plateau is going to continue with a slight decline in 24 again, and 25 or 26, we're going to probably see another big wave going back up. So that could lead to a very interesting buying opportunity.
But you kind of just opened the door to my next question. We've been mentioning these two companies a few times more recently, especially Deere, because I mean TFI has been around for like maybe 2 years, if I remember correctly. But
Actually, to be fair, I highlighted it in a newsletter in 2016. That's kind of
oh,
crazy.
I
Yeah,
didn't remember that.
TFI has been on like buy lists and recurring highlights at DSR. Not, of course, necessarily on that show, but when I did some research on TFI, I'm like, wow, I've been talking about this one for a long while, and I have yet not pulled the trigger in my portfolio. So it hurts to be right sometime.
But my point was that is it just a phase, or do they still show qualities to fit in a long-term strategy?
This is definitely a blurry line. It's always easier to get into a stock that shows a perfect dividend triangle where everything goes up all the time. But then you're going to get into those problems, as I mentioned, with Visa and MasterCard, where you always feel that you overpay for the stock. Now, when you have like those downtrend, it's just normal for the sector, but
Mm.
it still opens the door to maybe they're going to run into more problems. So for Deere, for example, so let's talk a little bit more about Deere for a while. It is a very strong player in the agriculture and the construction business, but there are other competitors out there, and
Mhm.
maybe they will not be able to benefit from expanding their brand in Asia, notably in China as well, because other competitors are rising. the need for new equipment may slow down because maybe farmers are just going to say, you know what? That's starting to get pretty expensive and we're just going to wait a little bit more. And ironically, is a synonym of like longevity, making like robust like equipment that lasts forever, high
Mm-hmm.
quality. So it's great for the brand name and it's great to get more sales in. But once you buy them, chances are they're going to just keep them for a while and repair them down the road. So
Mm-hmm.
those are like potential slowdowns that could happen for deer that may last more than 1 or 2 years. So you never know. But looking at the past, looking at how the business managed and went through those headwinds previously, I'm fairly confident they'll be able to keep on growing moving forward.
The consumer discretionary sector is not left aside when it comes to amazing dividend growers. BRP, so ticker is DOO.TO, Dollarama, DOL.TO, and Tractor Supply, TSCO, are good contenders, right?
Yeah, the three of them shows amazing dividend triangle. We're really talking about like those revenue growth, like 15, 20%, earnings growth, like 30%, 20% for each of them. It is almost intimidating to see those businesses growing and find ways to open new doors almost
Mm-hmm.
every single year. And I know I've been sitting on the sideline looking at those three, just thinking, oh my god, like maybe at one point I was like skeptical, and I've discussed Dolorama and the fact that I was not convinced they could pull it off like
Right.
every single year. But they definitely proved me wrong, and they should definitely be on anybody buys list right now to do some investigation.
And what would be your investment thesis for each, Mike?
So of course, the one that fluctuates more is BRP. So they're making recreative like vehicles. They come with new products such as like electric vehicles as well. They benefit from a very strong brand name. They sell their stuff everywhere on the planet, which is great. And I think it's an interesting entry point at this right now, mostly because since those recreational vehicles are relatively expensive and they rely a lot on financing to grow their sales. Right now, we will see a slowdown that may perdure for like maybe a few years, and that could create a good entry point after there was a huge hype around BRP. They're still a big leader in this market, so that could be interesting to see what's going to happen, what's going to develop once we go into another economic boom. As for Dolorama, I've discussed it a few times, but they have a clear plan on opening new stores and they now have a major investment. They hold a little bit more than 60% of Dollar City that operates the same playbook, but in Central America and Latin America. So the whole point here is to focus on opening new stores, dominate like small countries or large countries like Canada, but I don't think they're going to enter into the US for that reason.
Mm-hmm.
They are really really good at managing their margin. They have a lot of their own brands on their own products that will boost margin as well. And with kind of like seeing the consumers being tight on their budget for many years now due to inflation and higher interest rate, definitely Dolorama captured this situation. Definitely a resistant type of company as well.
Right.
As for Tractor Supply, this one is fascinating. It's like the halfway between a Walmart and a Home Depot, but in a very niche place. So they focus on being that general store for rural areas, people that have ranches or in large places. So they sell a little bit more of like larger equipments. They have been growing their business by opening more stores, and they made the acquisition a few years ago of PetSense. So now, because I mean, when you think about that, you're living on a ranch. Chances are you have horses and dogs and like
Right.
whatever other animals. So now they're offering those products as well. They have like multiple ways to improve their store. Still offer other types of products in there. So it's a great place to be for Tractor Supply. My only reserve here is the more they grow and the more they open stores, the closer they're going to get to a Walmart, a Lowe's, a Costco, or a Home Depot, and therefore going to get a little bit more into competition with
Right.
those. But in the meantime, it has been working very well, and they have a playbook they know by heart, and they apply it with a very precise way.
Listeners, for the best dividend growth stock ideas with metrics, we invite you to download our Dividend Rockstar list. Mike, what will they get?
Well, Vero, for all those episodes that we talk about the dividend triangle, I decided to use the DSR stock screener and pull out the list of all companies showing a positive dividend triangle. So on top of having a lot more metrics in the list, you're going to only have companies showing a positive revenue growth over the past 5 years, positive earnings per share, and positive dividend growth. I even spiced it up, adding the Chowder rule and adding a minimum 5% growth rate for the dividend payment, just to make sure that you search among the best dividend growers there is, and that is for both Canadian and US stocks.
It is totally free and it will be updated monthly, so please download it at thedividendguyblog.com/rockstar. Okay, so the last stock to be discussed today is probably among your favorites on this list, Costco, ticker COST. Its dividend triangle is almost perfect, right, Mike?
Oh, yeah. I mean, I would say perfect is a small word because they grow their business like there's no tomorrow. And on top of that, they offer special dividends. So it's not just the dividend is increasing double digit, they actually want to pay you even more. So they sound like an infomercial for dividend growth investors. Like, but wait, there's something else coming up with this deal. So yeah, I do like, I mean, of course, I'm fully biased. I do have it in my portfolio. I finally pulled the trigger last year before they announced their big $15 special dividend. So I was able to get some of the recent growth on the stock price. And what I like most about this one is the quality of their customers. Because the thing is, they work with a membership system where you have to pay a fee to be a member. And then when you get there, you have to buy in bulk. So chances are you're not going to get out of Costco with a bill that is lower than $500, which also leads to having customers that are making a lot of money. Because and therefore people that has like a lot of money, well, they're less affected by recession and they're still going to continue to go to Costco regardless. So you have a recurring business model with the membership. You target customers that will likely always see their disposable income increase no matter what's happening with the economy, and you build this bond literally with those clients that keeps on going there because they want to save time. They don't want to shop around, and they pay that membership to get those good deals. Not necessarily the best deal ever, but if you just go to one place, you get everything you need and you can go back home without having to check the price, without having to make 10 stops. That is worth a lot of money for those customers.
Right.
They also have a lot of growth potential by opening new stores. So their warehouse models doesn't cost much, right? I mean, it's just like a big structure, but like they don't spend much on marketing in there. And they could potentially go even more international. So they do have some international stores, but I see a lot of growth potential over there.
But Mike, isn't it starting to be like very pricey though?
Yeah, and one of the reasons why I wanted to discuss Costco today was because of that. If you've been listening to this show or like following any of my work, you know that I don't care that much about how much the price that I pay for any stocks that I had to my portfolio, because I'm willing to pay for quality and I'm thinking in decades. So I don't really care about that. Having said this, it is a very special situation for Costco because most of the time it's okay. Like Visa and MasterCard, we have discussed that today. But when you look, like one trick that I have is I always look at the average PE ratio over the past 5 and 10 years, just to have an idea of like, what's the regular price, the regular valuation the market is willing to pay for this business? And if the business has not changed much in their business model or the environment, it's relatively stable.
Right.
The thing is, when you look at Visa and MasterCard, they're trading like at a pricey point in terms of valuation. But when you compare over the past 5 and 10 years, what the market is willing to pay for those, it's pretty much aligned. So it's yes, it's a steep price, but it's a steep price that has been paid over and over for many years. Now going back to Costco, uh, the average of the past 10 years is like 32 times the earnings, but that is mostly because of low PE ratio between 2015 and 2019.
Mm-hmm.
After 2020, things get sour a little bit. So the average of over the past 5 years, that went from like 32 times earnings for 10 years all the way up to 39 times the earnings over just the past 5 years. So already you can see that the market is really getting into Costco. I mean, they just bought that membership and they just want more, right? But then you look at the current and the forward PE ratio that are around 50 times the earnings. So that's like kind
Mm.
of like paying a 25% premium on the stock price, which I mean, now it's getting very hard to pull the trigger because the problem here that you have is if you buy with a premium on the valuation of roughly 25 times the earnings, 25%, sorry, for the PE ratio, this could also lead to like no growth for like 5 years, just to let Costco to grow their earnings per share
Mm-hmm.
enough that it brings the PE ratio around 40 times. And even we could argue if 40 or 35 times the earnings is like way too much to pay for this type of business. I mean, yes, you pay for quality. We're looking at a business that is able to grow even organically by like high single digits. So it's kind of crazy. But still, I don't know. Like this one, I would put it on my buy list, but not pull the trigger now. I
Mm-hmm.
would yeah, I one of the first time that I'm hesitant because the market has just gone crazy for this one, and maybe just wait a little bit more could make sense just because the valuation at one point, I mean, unless Costco is able, like right now, it is priced the way that it is pretty much forced to show double digit growth for another five
Right.
years.
It creates like
So
very big
and
expectations.
yeah, very big expectations. And we could remember what happened with Walmart and Microsoft in the year of 2000s. Uh, the problem was not that the business was going anywhere, it was just the valuation. So they went
Mm-hmm.
with crazy PE. And after the tech bubble, kind of ironic to say that for Walmart, but it was true for Microsoft, they kept on increasing their earnings, but the stock price remained the same. Because every year, the only thing that was happening is the market reevaluating and lowering down the P ratio they're willing to pay for the
Mm-hmm.
same stock.
Mm-hmm.
Great company, bad price, that still happens.
Mm-hmm. And Mike, I'd like to add a side note that remains important to keep in mind as investors. And you kind of mentioned it a little in the 12 Stocks That I Hate episode, but we discussed this together not too long ago around a glass of wine. So I've noticed that many people have a hard time separating the business or the stock and what it has to offer from the feelings and opinions that we can have as customers or users. Costco is an example of that, right?
Yeah, I remember that discussion because ironically, big fan of the stock. I'm a member at Costco, but I let my wife go because I hate going there. But that's the thing. It's nice to use a service or buy a product and then be a shareholder because it makes connection in your brain. It probably helps you to understand the business model. It certainly helps you to boost your conviction
Hmm.
in that business because you're just thinking, oh, I'm shopping at Costco. I'm buying Doritos at Alimentation Couche-Tard because I have to say this word at least once an episode. My but then you like and the classic is, oh, I'm paying my utility bills to Enbridge is going to be there and keeps its dividend like forever. But that has like nothing to do with that. And here's like an interesting story. Like my youngest son, Caleb, a big hockey fan there. So we watch a lot of hockey games throughout the year. And this year he was like, "Oh, Dad, look, it's BioSteel. It's everywhere. They're like, even the NHL players are drinking it. And it tastes good." And I'm like, "Yeah, it tastes good. I mean, it's just like overpriced, whatever drink, but yeah, okay." And then at one point I'm like, "Caleb, did you know that BioSteel went bankrupt?" And he's like, "It's impossible. They're everywhere." And I'm like, "Yeah, well, marketing budget busted." And eventually, and during the playoffs, they were not there anymore. I think it was Prime or any other like trendy beverage.
It's a new one. I can't remember.
It's a new one.
Yeah.
But whatever. The point is, they spent a lot on marketing. They were everywhere, convincing people that this is the best drink ever. Unfortunately, they fail. So it's not because you use that, you drink something that it tastes good, that it's going to be great. And I mean, just to add on this, just ironically, I'm a Visa shareholder, but I only have MasterCards. I like all my telecoms at home are with Bell, and I have TELUS. And I do have no business with Royal Bank, and it's still my second favorite banks, and I still have a pretty good share on that. And just to end on this is, on the other side, you may have bad experiences or good experiences with a business, but those are just anecdotes. I remember like once I made a video on Couche-Tard because I never talk about this business, and a viewer on YouTube said, "Yeah, I went in one of their convenience stores, and just by the look at like how pricey the stuff was, and there was no one in that store, and then I went to another one on a trip, and it was the same thing. I'm never gonna buy this stock again." And I'm like, "All right, but how do you explain that revenues has more than doubled in the past 5 years then, if nobody's ever in that store and they're selling pricey stuff?" I mean, I'm not here to debate like whether or not you should buy in a convenience store or whether you should like have your telco's services with Bell or TELUS or Rogers. My point is, if you don't look at the numbers, what you believe or what you've experienced doesn't mean anything. It's just, it will affect your conviction positively or negatively, but that's not enough to have an investment thesis. Again, if you cannot match your thesis with numbers, just forget about it. Like those must come end in end. And there's a lot of companies in my portfolio that I don't buy their product or I don't really like them, but I'm like, I put my emotion aside. And when I look at the numbers, I'm like, well, I should definitely have it in my portfolio.
Okay, so thank you, Mike, for sharing these amazing dividend growers examples with us today. Listeners, start your research on the right foot by downloading the Dividend Rockstar list at thedividendguyblog.com/rockstar. For the show notes and related content, including the last 2 episodes, because we kept on mentioning them, visit thedividendguyblog.com/187. If you enjoyed this show, subscribe now not to miss an episode and leave us a 5-star rating. Until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.